Hi everyone, welcome to the first webinar for 2020's tax planning. We really hope you're excited today to get a little bit more out of your business and save some tax. So the whole point of today's session is really around your business not paying one more cent tax than you need to. We're not here to talk about trying to dodge out or not pay your tax. The idea is that you pay every cent that you're supposed to pay to the ATO. Now, by doing this, the idea is that we want to cut your taxes, capture more profit, increase your cash flow in your business. It might be to even out your profits and just generally improve the wealth of yourself, your family, your business, making sure you're going in the direction that you want to go in. So I'll jump on today and let's get started with the webinar overview. So first of all, we want to see if your structure is right. We want to talk about what instant deductions might be available, how you can utilize superannuation in your business to minimize your tax, different tools of trade, increase your income, maybe use some FMDs, and so much more. I'll try and keep it as simple and easy to follow as we can. And if you've got any questions, by all means, ring up, make a phone call, talk to us, and let us help you maximize your business. So let's get it started. First of all, what is your current structure? Do you have a structure that's fit for tax planning? Maybe you need to have a look at how your business is situated as to whether you're getting the most out of it and whether you're qualifying for some of those benefits that other business owners get in their structure type. Maybe it's the position that you're in now. Is it going to work towards your end of retirement options? What's your exit strategy? How are you going to manage that? How are you managing your growth? What's your next stage of your business life cycle look like? And how can you make sure you're maximizing the opportunity there? So obviously different businesses, structure types will pay different rates of tax. So it's important to understand how that will interact with your business. So there's lots of different structure types, but here's a few of the basic ones. You got sole trader, which means that you're just operating the business out of your own name. Now, you could end up paying tax rates of up to 47%. Most people pay around the 35 to 40 odd cents in the dollar tax rates, but if you're having an amazing year or an amazing business, 47% is a lot of tax. So then you could split it down into a partnership. Maybe you're working with a partner, and then you could reduce that down by splitting the profits to half, but it could still all end up at an all taxable rate of 47%. Then you can move into a company and only pay 27.5 or maybe 30% if you don't qualify for the small business options. And then the trust, it says zero, but it's not really zero. Trusts don't pay tax unless the money stays in there. Generally, you distribute the money out to the beneficiaries and they pay tax in their own name. The tax planning opportunities, obviously with sole traders, a lot less as opposed to having a more complex structure like a company or a trust. And then the worst part about it is a sole trader has minimal asset protection. So generally, we don't recommend anyone be a sole trader. If you're a sole trader, you've probably been a sole trader because that's how you started out, because it was easy and cheap to get into. And then as you move through in business, generally recommended you utilizing something like a trust or a company because of the opportunities for tax planning, but also protecting your assets and making sure that the wealth that you're creating for yourself or your family, it's going to stay there, that it can't be attacked. Now, that's a whole nother conversation around tax structures and minimizing risk. And I could go on about that one for a lot longer, but we won't today. We'll just continue on. Now, straight into it, obvious option here would be the instant asset write-off. So if you've probably heard about it, it used to be $1,000 a few years ago, then it got up to $20,000 and more recently $30,000. So in 2020, if you bought an asset for less than $30,000, such as a new car, you could write that off. Now, it's $30,000 depending on whether you're registered with GST. So if you buy the car for $30,000, you'll have to put that in the low value pool and then get the depreciation rates associated with that. On the flip side, if you buy it for $29,999.99, it's under $30,000. So therefore, you can just write that whole amount off. Now, a lot of people are like, oh, I'll just get a new car because that'll save me tax. My opinion is that cars are devaluing. They're not assets. They don't grow your wealth. Generally, if you need a new car, then I'm all for it. Go get a new car. But usually when you have a work vehicle, it'll lose value quicker because it'll get dirty, scratched, and dented because you're using it for work purposes. Other things to look out for when you're looking at new cars are the luxury car limits and potential FBT issues. So make sure that when you're talking to your accountant, you're looking at those aspects to make sure that you're avoiding them. On the flip side, plant and equipment is another great option. You might need a new laptop, or maybe you need new fencing, or some sort of safety equipment, or a tractor, whatever it is. If that's under 30 grand and you need it anyway, it might be a great opportunity if you've got a bit of extra cash to buy that plant and equipment. You could, if you're having a good year and maybe you haven't got the cash, rather than paying that tax, so you could end up saving yourself paying 10 grand tax on the $30,000 asset. Therefore, saving 10 grand tax and getting a loan might work out as a great option. But again, it's having that discussion with your accountant and really making sure that you've nutted out if this is the right direction that you want to go in. If you're talking to your accountant when you're having that tax planning meeting, have a look at your low value pool. If your low value pool comes in under 30 grand because you haven't added to it for the financial year, then you might be able to write that off. So you're just writing off assets that you already own. It's a great opportunity to plan it out. It can also be somewhere where you can fall victim, where sometimes accountants will just write it off for the sake of it when you're having not a great year. You really want to make sure you're maximizing the use of that write-off when you're having a good year. In the bottom right there that you can see, we're looking at the greater than 30K. If it does go in a general pool or a low value pool, then you're looking at the general pool of 15% in the first year and 30% for future years. So it's not all bad. It still means if you buy a $50,000 car, you're still going to get $7,500 deduction potentially. So there are plenty of options there if you're looking at bigger value items for your business. Moving on to superannuation. So if you've got superannuation options in your business, so you can either maximize your own super contributions up to $25,000 up to the age of 65. Don't go over this amount. Make sure you're talking to a financial planner or your accountant to make sure that you're not going over the age limits, if you're passing work tests, all those sorts of little tricky bits to maneuver around in maximizing your super contributions. But the benefit of that one is whether you're a sole trader, company, trust, it's available to pretty much anybody. So maximizing that $25,000 deduction is a great opportunity to save on tax. So if you're currently putting nothing into super, putting 25 grand in there could just save you, most people around $8,000 or $9,000. That's a big amount to save. And then if you're over 60, there could be other opportunities there, such as transition to retirement and things like that, where you can put the money in and pull the money out. Again, talking to a financial advisor, making sure you're ticking the boxes in the right way there. So the best thing is, even if you're an employee, so if you're a sole trader or own a business, yep, you can do it. But if you're just an employee, it could be an opportunity where if you have a trust and your partner works and earns 30 odd grand, maybe you distribute 20, 30 grand to your partner, and then you increase their superannuation deduction to the maximum allowable limit of $25,000. So effectively they paid less tax on that money because they just claimed a super deduction against it. You could prepay super. So if you have a self-managed super fund, you could pay the super before the end of financial year. So you could pay your 25 grand, and then depending on your position in your SMSF and the trust deed, again, you need to talk to your accountant to make sure you're ticking off on all these boxes. You can put 25 in now and 25 in on the 30th of June, put it in a holding account, effectively get 25 grand for this year, 25 grand for next year and this year, and therefore $50,000 deduction reduces your income this year, but Obviously, you don't get to claim the 25 grand again next year. You'd have to do the same thing again if you had a great year next year and just continue it on. But if you know you're having a great year this year and next year's not looking so great, I'm all for taking the deduction now, because you never know what next year might hold. Low value and high income earners, you've got to be aware around the co-contribution if you're a low income earner, because getting the tax deduction might be great, but if you put a bit in as non-concessional contribution, so you're not claiming the deduction for it, you might also get a co-contribution. So therefore, the government's giving you money for putting extra money into super. What a bonus that can be. I mean, generally, it could be a small amount, but it's something's better than nothing. If you're a high income earner, you've got to be aware that if you put extra money into super and you earn over $250,000, you'll end up paying extra 15% tax on that to bring it up to 30%. So it's still tax effective, but not as effective if you're earning less than 250K. But I mean, let's face it, 30% is better than 47. So make sure you talk to your accountant, see where you're sitting, assess the situation, and then pull the trigger. Let's have a look at the next one. So you're gonna pay less tax now or later. So moving income around is just a great strategy for business owners when you can bring forward income or expenses. So if in 2020 you're not having a great year, try and bring forward the income from next year into this year if you can. So sometimes farmers and stuff, especially, they can manipulate their wool or seeds. They could be selling stock now. There's a lot of different things and opportunities they can deal with different boards to bring money forward and backwards. Similar in the way with the farm managed deposits. So if you are not having a great year this year, bring out a FMD, have the cash sitting there, and then next year, if you have a good year, put the FMD back on and get the deduction for next year to reduce your income next year. So again, with expenses, you could bring forward the expenses into this year if you're having a great year. If you're not having a great year, hold them off and pay them in July. So pushing and pulling that income can really help you out for either 2020 or 2021, depending on when you need that deduction. So if you're pushing it back, same principle. If you push back the income into 2021 because you know you're having a great year this year, you're just trying to level out your income. I find a lot of people as individuals tend to not always pick the great time to sell their rental properties and things like that. So if you're having capital gains and you're looking at selling some shares, key date is to look at is the contract date, and make sure that if you're having a big year, try and say, well, maybe I'll hold off and push it into next year. If you're not having a great year, then maybe it's a time to sell that big asset, get the capital gain now, and pay less tax. Also, could be an opportunity where you sell some loss assets. So if you bought A&P shares at $10, now they're worth $2, then you're making a loss on that asset, and you're like, I don't want to hold that anymore. So you sell the asset, take the loss, and apply that against your capital gain, reducing your capital gain, therefore reducing your taxable income for the year. So it's all about that planning and understanding where you're at. So there's also some other little ways where you could be reducing your tax because you're paying for it anyway. So there's some repairs to be made around the place, and you're like, oh, do I do it now or do I do it later? Maybe you do it now and get that, reduce your taxable income now because it's higher, whether you're going to do the repairs or not anyway. Tools of trade is similar. If you're working as an employee, you can salary sacrifice things like tools of trade, like computers, laptops, iPhones, whatever it is that you use. And if you're going to be buying them anyway, then you're having a good year, buy them now. So it could be that some safety rail or something, and you're going to use it anyway, buy it, get it, use it, and then buy it now while you're having a good year. Logbooks, especially important with motor vehicles. So we find a lot of people that they might be just claiming the base level, or they haven't done a logbook in a while, so they're actually missing out. Most of the time they're missing out on deductions. So it's important to have that logbook for FBT reasons, but also to maximize the claims against your taxable income. And you need to do that for 12 weeks. So if you haven't got your logbook, get your logbook out, start taking that one. Employee super is a really great one because a lot of people pay it before it's due. So your end of year one is due in July. Well, there's no reason you can't pay that on the 15th or 20th of June and pay it in advance, and then pay the remainder in July. So get a bulk of the super paid in this year. If you're having a good year this year, then pay it in this year. Bring forward that expense. You're going to pay it anyway. Bring it forward, pay it early. That brings me to things like rent. Prepay your rent, prepay your interest. If you've got interest on loans, you could prepay the interest to bring it forward into this year. You're going to pay it anyway at some time. I understand that it all comes back to cash flow. You've got to have the cash to pay it, but if it reduces your tax, you've got to weigh up, can I afford to pay it now, or am I going to pay it in a few months anyway? Tidying up the house. So end of the year, it's a great opportunity to look at your Div 7A loans if you've got a company. So if you've got some loans, ensure that the appropriate principal and interest repayments are made by 30th of June. If you're not sure, talk to your accountant, make sure you're on top of your Div 7A loans. This year, there's a lot of changes going on with that, and the ATO are going to put that right under the microscope, so you need to be 100% on top of it. Year-end stock take, make sure you've got your year-end stock take done, see what your work in progress is at. It could also be a great opportunity to review your stock. If you've got some stock you need to write off or it's obsolete, write it off. Get the deduction now, reduce your income. If you've got some bad debts, write off the bad debts. So if you're on a cash basis, this is of no use to you. If you're on an accrual basis and you've got bad debts, then now's not the time to have a bit of an assessment and write them off. Make sure you've got that process down pat so that you're regularly reviewing your debtors, chasing them for money, and if they're not going to pay up, at some point, write them off, reduce your income, done. If you have a trust, make sure those trustee resolutions are prepared and signed before June 30. So obviously when you're doing your tax planning preparation, having those trustee resolutions ready to go are a great opportunity because you can already foresee who should be getting the money and where it's best going to be allocated for the 2020 financial year. Don't pay 1 cent too much tax. So we're not about doing dodgy things here. You know, we want to do everything above board, but there's no reason for you to spend 1 cent more tax than you need to. At the end of the day, unless you think the government's going to spend it better than you would, or you'll want less super or less wealth for you and your family, then do what you've always done. If you do what you've always done, you're going to get what you've always got. But as far as we're concerned, we want you to pay less tax. So come see us, book in, get a tax planning session. At a bare minimum, if you can't afford it, do it yourself. There's a bunch of blogs out there. We've got a big blog article on ours. Have a look at it, review it, see if you can do it yourself. At the end of the day, a tax planning meeting with us, you book in and save. What we need is just your income, your expenses, and your profits, all your wages, income items, interest, dividends, rental income, and any potential capital gains and losses. And from here, we can sort of project out where your income's going to be, and we can discuss what opportunities might be available to you. Your investment's only $300. So it's not a big investment. And we're 100% confident that if I can't save you $300, you'll pay nothing. I'll refund you the cost of the meeting. I don't want you to be out of pocket. I honestly believe that just about everyone has an opportunity to save money and pay less tax and improve their cash in their business. How hard is it? Book online. Just simply go to www.edgea.com.au. The top right-hand corner there's a meeting button. Just hit that and select tax planning meeting. Simple as that to book in. And yeah, if you want to save tax, increase your wealth, increase your super, don't miss out on any opportunities. There is so much out there that you can do in your business to pay less tax. If you're not doing it, you're missing out. Hopefully today's session has been of great value to you, and we really hope to catch up soon. If you've got any questions, by all means, drop us a line and we'll catch up soon. Thanks for joining me, and I'll see you then.